Mark Mahaney.
And big tech is at the top of the S&P 500 this morning, thanks in part to Alphabet, soaring 8%. Apple also up 3.25%. Big move for the mega cap. Still to come, the key takeaways for investors from this morning's consumer reports as Macy's leads the charge with double-digit gains. And later on, Jefferies strategist and Fed chair contender David Zervos. Big show still ahead. Stay with us.
You download Dave.
Just over 30 minutes here into the hour. Here are three big movers we're watching, all in the consumer space. Macy's shares are surging after beating earnings estimates by more than 20 cents. Revenue also a beat, and they raised guidance, citing a resilient consumer of 20%. Different story for Dollar Tree. It's under pressure despite better than expected results and same-store sales. Full-year guidance falling short of estimates, stock down 8.5%. And then Campbell shares higher as well, despite a miss on revenue and negative organic growth across segments. Executives on the call saying, quote, consumers remain cautious and continue to seek value in a variety of ways, such as cooking at home, but arguing that's a benefit for their meals and beverage business. So kind of a mixed bag, but overall stock liking it. Staples a little more in demand these days on the defensive tone in the market.
Right. That said, close to session highs here. Let's get a news update with Silvana Henao. Hey, Silvana.
Carl, good morning. A federal appeals court rejected President Trump's attempts to use the 18th century Alien Enemies Act to deport immigrants his administration accused of belonging to a Venezuelan gang. A panel of judges voted 2-1 to block the deportations, ruling that the administration's claims that the alleged gang members are part of a warlike invasion is not true. The ruling is likely to end up before the Supreme Court. a show of military might in China today as Beijing hosted world leaders ranging from Russia's Vladimir Putin to North Korea's Kim Jong-un for a parade commemorating the 80th anniversary of the end of World War II. China displayed air defense lasers, hypersonic weapons, and its full nuclear triad of weapons at the gathering in Tiananmen Square. And Putin said after attending the spectacle that he is ready to meet with his Ukrainian counterpart Volodymyr Zelensky and suggested the talks could be held in Moscow. His comments came after Russia launched more than 500 drones and dozens of missiles at Ukraine overnight, Sarah.
Okay, thank you, Silvana. We are just about an hour here into trading. And stocks, as mentioned, Carl mentioned, near session highs, at least with the S&P. Dow's under pressure. Tech is leading today, so it's kind of a mixed bag as far as sectors. Communication services, technology, and consumer discretionary are all higher. Everybody else is lower. Energy's at the bottom of the barrel, down 2%. Utilities, staples, industrials also weaker. Jefferies strategist and Fed chair contender David Zervos joins us next with his take on the market action. And still to come, the CEO of HP, Enrique Lores, with his read on how consumer demand for PCs, particularly those AI PCs, is showing up and any impact he's seeing from tariffs. We're back in a moment.
Jim.
Welcome back. Fed Governor and possibly next Fed Chair. He's in the mix. Christopher Waller joining Squawk Box earlier this morning, supporting, no surprise, a rate cut next month and beyond. Listen.
I think we need to start cutting rates at the next meeting, and then we don't have to go in a locked sequence of steps. We can kind of see where things are going because people are still worried about tariff inflation. I'm not, but everybody else is. So I would say over the next 3 to 6 months, we could see multiple cuts coming in. Whether it's like every meeting, we'll have to wait and see what the data says.
All right, let's bring in someone else in the mix. Jefferies Chief Market Strategist David Zervos with his outlook. It's not surprising that Fed Governor Waller, who voted to cut last meeting, wants to cut this meeting. I would imagine you agree, or you think we should see cuts?
Sure, absolutely. Been pretty clear about that, and our notes to clients, as well as discussions with you and others on the network. I think there's a very cogent case for much lower interest rates.
Much lower? What do you mean much?
Well, Sarah, I've been arguing even back in the summer months of last year that the neutral rate is probably closer to 2 rather than 3%, and that as the balance sheet comes down, we lose that stimulus from the balance sheet, and we need to get rates back toward a more neutral place. That we've had a kind of temporarily high neutral rate because the balance sheet was so big for so long, and now that's just not the case anymore.
Where do you see it hurting the economy?
Clearly, the interest rate sensitive sectors. We all know the story. Housing, I think you just talked about that with Joe Livornia. This is not a symmetric distribution of Fed policy when you have the rate structure so high and the balance sheet that was high now coming down. So for me, it's an unfortunate situation that politics have gotten in the way of getting rates back to a more neutral place. I think a lot of miscalculations were made, but also some people with desires to act a little bit politically.
You really think Fed Chair Powell is not cutting rates because of politics?
I think there was a lot of pushback in April. I do. I think the tariffs really, the whole let's not enable these policies idea played a role in how Fed policy evolved post-tariff. So it's unfortunate, but we'll get through it. It's not the end of the world. The policies on fiscal, trade, immigration, regulatory policy, they're going to dominate. But it's just unfortunate that we have to have a little bit of a headwind from monetary policy that's, in my opinion, unnecessary.
Although, is there ever a situation where people jawbone the Fed to raise, to hike, right? I mean, political noise always wants cheaper rates.
I think, yes, and it comes from, we've seen letters from Maxine Waters, Sherrod Brown, Elizabeth Warren, all throughout the pre-election period. Please cut, please cut. And certainly we're finding out that there was a lot of pressure, maybe even behind the scenes with Janet Yellen, Lael Brainerd, Lisa Cook. All of that is political in nature. And then there's political on the other side. This is always going to be a political volleyball. And I think the Fed has to navigate that and has navigated that in some ways in a sort of eloquent way, in some ways in a clumsy way, and I think this is a big clumsy.
I genuinely think that Powell and maybe others are worried about inflation as a result of tariffs. I mean, someone pays for tariffs, right? And it is usually the consumer. I have been saying every single day, it's great that we're not seeing big spikes in consumer price index. However, the risk is there with tariffs out there, no?
It's always a risk. I mean, what are you doing when you're running monetary policy? You're risk managing a situation. You're trading off these inflation and employment goals. You're taking some risk with inflation to get more jobs or vice versa. So I think the leaning on the risk side has political biases. That's all. But it's natural. I mean, look, when someone goes in and gets a job at the Supreme Court and becomes a justice, do you say, oh, they're immediately independent? They're somehow not going to hold true to their political and their principles that they believe in? I mean, there's clearly, a lot of different beliefs on that Supreme Court today, and they don't just leave them at the door when they go in to hear cases. So I don't think we would expect that at the Fed. That's why it's always so surprising to me when we hear these, constant discussions of elevated independence at the Fed when we know people bring their biases to the table. And they should. They should bring their views, their economic views, their political views. They should bring everything to do the job the best they can, which is to maximize employment and keep prices stable over the long run and not bring in a lot of these other goals that have creeped in, like inclusion and other stuff that
it does sound, though, like you see value in disparate points of view. Is there danger in sort of packing the committee?
Well, I don't really worry about that at this stage because the committee's kind of been pushed probably more toward the left side over recent years. So balancing it out seems like a healthy story. But yeah, I would say in government, it's always better to have a balanced view. I love the idea of having a debate with people with opposing views. I do that every day at Jefferies. That's my job. As I go in, sit with clients, I'm going to do that all afternoon with some very big clients and debate the macro view. And we have differences of opinion. I think, again, not to bring up your interview with Joe Livorni again, which I thought was great. He said it again when you asked him about what he'd like to see at the Fed, which is more open discussion. And I think we've lost a little bit of that. There's a lot of groupthink. It's nice to see Mickey Bowman and Chris Waller dissenting. Yeah. It's nice to see that there's others that are likely to come on that have a different view than that Keynesian. I think Joe actually used the DSGE words, dynamic stochastic general equilibrium, whatever, blah, blah, blah. It's nice to see different neoclassical views or supply side views, as I like to call them, come into play. That'll be fun.
Just one more on your call to lower interest rates by a lot. The stock market's at a record high.
Yeah.
Credit spreads are very tight.
Almost at records, yeah.
Almost record tight. These are very easy financial conditions, which would not usually mean time to cut rates.
Well, there are other parts of financial conditions, currency markets. Dollar's still pretty strong, although it's weakened a bit.
It's down 10% this year.
Yeah, but it's still very strong. I mean, 1.16 euro is still strong by most standards, and the DXY is at high. There are plenty of other things that come into play with financial conditions, but that's not the only reason, Sarah. We've had a major disinflationary period that has come into play since the peaks of 2022. And there's no reason for us to tie our hands behind our back or one hand behind our back and not let this economy grow even faster. As I think you said earlier in a segment, the Secretary of the Treasury talked about having 4 or 5% growth if we can get this trade policy sorted out. Why should we handicap it because of some phantom fears of inflation that have really not materialized? And it was nice to see Jay make a pivot in the Jackson Hole speech. I thought that was helpful, but it is a little too late, I think, from the perspective of getting monetary policy on board with the rest of the policies that are out there. We could have much more strength and a much more robust year-end and 2026 if monetary policy got out of the way a little bit.
Have you made sure to not declare primary residence on 2 different houses that you own? Have you checked?
I have checked all of my. It's been a long time since I had a mortgage in Connecticut. I still have my mortgage in Florida, which is where my residence is, because I like the tax deduction there. But I moved my residence to Florida way back about 10 years ago. But I come here to visit you guys.
Yes, you did.
We are very grateful. David, thank you very much for taking all the questions. David Zervos from Jefferies.
Coming up on Money Movers this morning, don't miss the CEO of cybersecurity firm Zscaler. We'll talk to Jay about the quarter. Shares are moving a bit lower despite the Q4 beat. Year to date, Zscaler still outperforms some other names in the space like CrowdStrike and Palo Alto. That's all coming up at 11 a.m. Eastern in just a few minutes. We are watching for August auto sales with Ford out last hour as the transports kick off September in the red. Our Phil LeBeau's this morning here with the breakdown. Hey, Phil.
Hey, Carl, transports may be in the red, but the automakers, they had a strong month of August, and the numbers we're seeing this morning, it backs it up. Take a look at Hyundai, Kia, and Ford. Those are the first three that we received this morning. Strong numbers from Hyundai and Kia. In fact, they were monthly sales records, up 11.6 and 10.4% respectively. Ford up 2%. As you take a look at shares of Ford, August EV sales, and this is going to be what we hear from a number of automakers. For Ford, they were up 19.3%. Also had a strong 14% gain in hybrid sales. That's where the market, where the demand is right now, because the federal tax credits expire at the end of September. Anybody who is on the fence is thinking about buying one. Take a look at General Motors. It's not reporting its full August sales, but they did release that they had their strongest EV sales for any month in the month of August. As you take a look at auto sales, annual auto sales, a reminder that the expected pace for the month of August, 16.1 million vehicles, though I should admit, Carl, that I've heard from a few people who have said, I think it's going to be a little higher than that, probably 16.3 million.
Yeah, not quite the pace of those recent years as we see from that table right there. Phil, thanks. Phil LeBeau this morning watching some cars. After the break, we'll turn back to Google's big win in court and why it might be a bigger deal for Apple when Money Movers begins in just a minute.
today. November 18th.
Peacock.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The stunning Google move on the back of that court ruling. We are trading it and the fallout for the other mega caps. Joining me for the hour today, Joe Terranova, Liz Thomas, Steve Weiss, Jim Lebenthal. We'll check the markets. It is a NASDAQ story today for obvious reasons. Not the only story. I mean, gold is a new record. Yields are higher. The 30-year boil is off a little bit. Governor Waller tells Steve Leisman could see multiple cuts over the next few months. We'll get to all that. But the big story is the mega relief for the mega caps, maybe as a whole, certainly for one of them. After the judge rules Alphabet won't have to break up, Google hits a record high. It is the best day since April. Farmer Jim.
Your Honor.
Alphabet is now up 39.5% since the so-called Eddie Q sell-off. That was May 7th. You said everybody pipe down. Relax. The stock is just fine. The company's just fine. Now what you say, my friend?
Now I say it's still undervalued, and a meaningful overhang has been taken out of the name. You never know what's going to happen with these things. The judge can go any way they want to. But the idea that we would be talking in May, as you referred to, Scott, about competition eating Google's lunch, and at the same time that this judge would rule that there's a monopolistic practice here at Google, well, that was the ruling, but that the punishment would be draconian to reflect that monopoly, that was completely in Congress. You can't hold those two thoughts together. So although it was not a fait accompli, I'm very delighted. This is the news I expected. And now the overhang's gone. And what you've got is a stock that's trading at the low 20s. I think it's about 22 times forward earnings. You compare that to the rest of the Mag 7. And like the rest of the Mag 7, this is going to be an AI beneficiary. Yes, there is competition, but this is Google, a multi-trillion-dollar company that has been at AI for a long, long time. People don't remember that, but it's been at this for decades, and they have a viable product. That's showing up, by the way, in their quarterly results, which I expect will again be the case in the quarter to come.
You catch a fair amount of grief from the bench, and now you get some love. Because, I mean, you told people to just chill, relax, don't make such a huge deal of the Eddie Q thing, even though it's not like it's an insignificant point that he was making. It's just the stock's up a lot, and this is a big deal. 9 target hikes at least that we could find today. What do you think about this? I'd like Jimmy declared this, even with the gain, still undervalued. Well, if you look at mega cap valuations, it certainly has a lower forward PE than the others. Did we make that up? Let's show it if we have that. Because Amazon's like at 32 plus times, as is Microsoft. Alphabet's at 21.3 times. Maybe it's a little more now because of the gain that you're getting in the stock today. But nonetheless, does this start to close? Does this closure, if you consider it that, close the gap from a valuation standpoint between Alphabet and some of these other names?
Jimmy nailed it. Yeah, this is removing a significant obstacle, and I agree with you. I believe there's further upside potential here. When you look at the sum of the parts, you look at the various businesses and the valuation here, one can think about this company trading with a market cap exceeding $3 trillion very easily. Just thinking about the combination of a very powerful Waymo business, YouTube TV, the cloud business we know is doing well. And when you think about the valuation of OpenAI, how that has grown so dramatically to over $500 billion, what does that mean now for the valuation of Gemini and for Google Cloud itself? So it lifts the obstacle. It absolutely is a clearing event. And I also think it benefits the entirety of the AI halo because it gives now Google the opportunity to go out and actually spend more. Google doesn't have to sit back and concern itself with these antitrust fights.
I'll tell you what, this is an antitrust issue, quite obviously. It doesn't eliminate the broader question, like the one that Eddie Q raised in the courtroom, of whether these large language models and these co-pilots and generative AI deals are going to cut into the monopoly that they all but had in search. This does nothing to address that, does it?
That's fair, but it does allow them the opportunity for a very cash-rich company to go out and actually spend and defend against that loss of market share that potentially is coming. So
you're pointing out something very important. This is a huge company. The huge companies in any industries win by virtue of their size, by virtue of the resources, whether it's financial, as you're pointing out, or as intellectual, as I was pointing out before. I think this is very important. This is why I was so calm on the Eddie Q comments. It's a $2 trillion company. Now, I was surprised that it became a battleground stock. This was one of the more calm moments that I've had when defending a stock because of the size, which you're speaking to, Joe.
Well, you own it too, obviously. Do you think it's a value? You start to close the valuation gap now?
I think you can close it somewhat more, but I don't think you'll close it completely. This stock is always sold at a discount, or generally. I don't want to say always, because that's just too strong a term. But it's generally sold at a discount over the last 5-10 years to some of the others, including Amazon. But here's what it also does, which I'm not aware that most are talking about. Gmail, Google Mail, is the dominant player in mail in the U.S., in email. Without the microscope on them for anti-competitive activity, they can do what Netflix has been doing. Now, they've raised prices somewhat, but they can raise prices more now without the glare of antitrust proceedings on them. So I think there are multiple levers they can pull to drive revenue, to drive earnings, and I'd look forward to them doing that. I've thought about this quite a bit, is that how much of that headwind from the antitrust proceeding was still in play? I mean, the stocks recovered from 165 to 200 before this. So you got to believe some of it was discounted. Now, when it was at 165, everybody
Look at
crushed.
the move in the stock today. It would say that
I'd say some of it has
the
been
market
discounted.
maybe didn't expect this outcome.
No, clearly it didn't. Clearly didn't. But you still have the headwind of search share and of giving up some of their data.
I know, but the whole point is that maybe all of that was overblown.
No, and I think it was by today, but what I'm saying is that's the reason why it won't recover, or it won't go to the extent on a multiple basis that you see Meta and Amazon and others at. So that's my point. You'll continue to see it move up. And I think the headwind of losing position in search is overstated, because they'll still be the one to dominate advertising just because of their share they'll have. So I like it. I'm staying there. I debate about buying some more when the announcement hit, but I choose to wait for it to pull back a little bit because I think that's what will happen.
Liz, I'll make this quick. Meta is, you mentioned it, it's the direct comparable here in terms of what the stock does next. 2 years ago, Meta was trading at a high teens forward multiple. Many people, and I think it was you, Steve, it wasn't me, bought the stock at that point in time and have enjoyed both a multiple expansion and earnings growth. And that's exactly what I think you're going to see with Google over the next year to 2 years.
Aren't you talking about, you're talking about a stock move, but you're talking about apples and oranges in terms of issues.
You're correct. You're correct. I'm talking about a stock move in terms of what to expect. You're absolutely. There are some similarities. I mean, Steve was just bringing up email. Well, let me extend this, because Steve was just bringing up email. It's only one piston in the engine. There is YouTube, which I would say is a direct comparable to what's going on at Facebook. But yes, Scott, there was the year of building out the metaverse, followed by the year of efficiency. I'll grant you. I'm simply saying, from a stock point of view, absolutely Meta is the comparable in my mind.
So, Liz, you look at this trade lately, which has been somewhat in question as you head into a new month. This is just what the doctor ordered. If you can remove some sort of regulatory and antitrust overhang over the space, what's that do?
I mean, it certainly helps. It removes one of the skepticisms that people might have had about current valuation levels. I think we're talking about some idiosyncratic issues with one stock, though. But when you look at the trade itself, if we're just talking about mega cap tech, or even if we're just talking about semiconductors and everything that has been under pressure over the last, call it 5 trading days or so, you can't remove the fact that what's happening in the rest of the market, especially with yields, is probably pressuring them as well. And I talk about the relationship between assets a lot. This is a relationship that I think right now is intact. You've got long-term yields rising and long-duration stocks under pressure. That makes sense. This could be a period of time where we're just sort of normalizing to a level of yields that needs to be more rational given the environment, a level of inflation that's perhaps digested by the economy so far, in which case then you look at long-term stock valuations, they didn't make a whole lot of sense. Investors were wrapping themselves into pretzels trying to make a case for why it was a buy at these levels. So some of these shakeouts I think are pretty healthy.
It's not just a Alphabet story today. It's an Apple story too. Higher on the ruling, because they're going to continue to get paid billions of dollars so that Google's the default search engine. Morgan Stanley today says it's the near best case scenario for Apple and should be a clearing event for that stock. Now, maybe we already thought there was a clearing event for the stock, which had led it to appreciate to where it is today at 236. So it's up nicely too. Bank of America raises its target to 260. It's a $10 boost. They reiterate their buy. Wedbush's Dan Ives, who's going to be on Closing Bell with me later, says monster win for Cupertino and for Google. I think most would agree, Joe, with those statements.
So Apple exceeded the August 14th high at 235.12. That clears the path now towards 260, which was the December high. The first real clearing event occurred on August 6th. I think there's a similarity between how you think about sentiment and positioning for Apple at that moment to where Alphabet is today. So I think you will see that valuation spread narrow, because I do believe Alphabet will catch up to Apple. I think Apple is going to be more of a staircase move higher here towards that 260 level. I think Alphabet has the ability to very quickly advance on a rebuilding of position.
We're going to have some tests coming up, too, that are still to come about the state of the AI trade. You're going to get one tomorrow with Broadcom. So, NVIDIA's done essentially nothing since its earnings report. It obviously had the sell-off following, but how much does this one matter on top of that?
I think it matters significantly. Look, I'm not going to pretend to sit here and know the direction that the stock is going to move after earnings. You're going to have earnings and revenue growth somewhere around 20%.
Well, if you knew that, you wouldn't be sitting there right now.
Well, there are some times. There are some times.
So if you knew that, where would you be?
So there are some times that we go into earnings, and we've done that in the past, and we've said, look, we feel really good about the potential for this stock to move higher after earnings or move lower. I think this one's a coin toss. I think that there was going into this a very high expectation surrounding what they had to deliver fundamentally. Maybe NVIDIA offered a degree of relief with that post-earnings sell-off last week, but this is a company that when you pull the lens back and you say 30,000 feet, how integral are they in the logistical build-out of artificial intelligence? They're vital because they are delivering the integrated circuits that allow the chips collaboratively to work together, and that is vital.
What's the PE on Broadcom forward? Can we find that out, guys, in the control room for us? I mean, when you look at that relative to, say, an NVIDIA, which is like 32.5 times or something like that. So this one's a little richer, right? It's almost 42 times.
45-ish is what I'm seeing right now.
Okay, does it deserve that?
I think it does, but it does place it in a valuation level that is higher than certainly it has been for the last 10 years. And 2 years ago, when you spoke about this company, they were a reasonable valuation alternative to names like AMD.
Well, AMD's been priced at a discount to NVIDIA and Broadcom for a long time. But I've never understood the valuation on this company, frankly.
On Broadcom?
Yeah, on Broadcom. I think it's excessive. Their growth is good, it's strong, but I'm more of a cash flow investor. And when I look at their EBITDA valuation, which is their cash flow, I get a number that's too high. Now, they're growing cash flow about 35%. They're growing earnings at about 40. So you could say it's trading at a one peg or so, and that's reasonable. But it's also a commodity company in a lot of respects. So it's second to NVIDIA in terms of the growth.
Well, you just buried the lead. It's second to NVIDIA.
Yeah, in terms of the growth, right. But it's a much broader business also. It's in a lot more commodity businesses.
VMware.
Right.
There's components of it.
Right, and VMware was not a great public stock for a long time because of slower growth. So I'd still rather own Taiwan Semi.
Well, the news with the White House revoking the waiver for it to send the equipment to China, how does that factor into how you think about that stock? Because that news was just happening in the last 24 hours.
Look, tell me what happens in the next 24 hours because it could change. So I just don't think that you get worked up about that. Market's not worked up about it. Taiwan Semi's just got a massive business outside the U.S. The issue that a number of these companies are having, and we're involved with one of the largest semi companies, is that the money they said they'd spend in the U.S. to build plants here, they're now cutting that back because they are going to be taxed on what they sell outside the U.S. So that's got to come. So Trump administration have to come to grips with that. So you may not see that. The waiver may be reinstated. You just can't bet on what these tweets are and what policy is today because it changed tomorrow.
We thought there was an interesting note today from UBS, which talks about positioning within tech as it relates not only to antitrust risks fading, but the AI trade in general, in which they are urging investors to rebalance tech exposure away from large cap semiconductors and towards AI laggards that have not rallied as sharply. They want you to identify, still within the AI theme, but names in the defensive software space. That got us thinking, is that the cyber trade? Because that's lagged.
Yep.
That's lagged considerably quarter to date. we'll show you what's happened here. Fortinet's down 27.5% in the quarter. CrowdStrike's down 20. Zscaler's down 16. Checkpoint's down 14. Okta's down 11, and Palo Alto is down 7. Zscaler gave a pretty good outlook, but you wouldn't know it from the way the stock is reacting today. Let's look at that one. What do we think about this note? Why don't you weigh in on that, Liz? Away from large cap semis, let's say away from the NVIDIAs and the Broadcoms and maybe the AMDs and whoever else you consider to be a large cap semi, and into some of these defensive software names that have lagged significantly over the last few months.
So the last time I was on Halftime, I used software as my final trade. I don't work for UBS, but I happen to agree a lot with this statement. I think that when you look at the AI trade broadly, software companies are not typically the ones that come to the top of the bubble. Cybersecurity certainly aren't the ones that come to the top of the bubble. So they just haven't been the darlings on this. They've been sort of left behind. But I don't think these companies have done anything wrong.
They haven't really been left, but let me stop you for a second. They haven't really been left behind until the last few months. They had the charts almost all look the same except for a name or two. They were, up and to the right, almost unabated. CrowdStrike had its issue. Yep. And then before you knew it, the stock had regained everything that it had lost. If you look at some of these names, you'll see. So yes, it's been a lately story. They haven't suffered any more than lately.
But they've trailed. So when I think about technology as a sector, you split it up into industry groups. I'm constantly comparing software and semiconductors. You look at semiconductors as the cyclical component of that sector. Software historically and still today, I think, does become the more defensive posture of that sector because it's usually more sticky revenue, the contracts are longer, so on and so forth. They don't trade the same. So software, when compared to semiconductors, was left behind or at least trailed last year. Did better than the broader market, but trailed. Coming into this year, my thesis was that this was the time when software could shine. It was time for all of these promises for AI to be put into action. Software was going to be the conduit to actually make that happen. That hasn't really materialized in the way the stocks have traded. So I think that software, having been left behind even in the last 2 months, is a good opportunity for investors in the cybersecurity space, although not a direct AI play. We don't necessarily talk about it that way. I think it's also a good opportunity for investors for a long-term period to get a position.
You see, I'd say the reason for
you think it's time to rebalance away from like large cap semi into some of these names that have gotten hit pretty hard? That's the crux of our conversation.
Definitely not cyber. Because cyber it makes Broadcom look like it's being given away. When you got CrowdStrike trading at over 100 times earnings, when you've got Zscaler trading at over 75 times earnings, and ridiculous multiples on cash flow in the 30s on an EBITDA basis, I don't know how you put new money in there.
Well, ask Joe.
So the 6 names.
He owns like
the 6.
Fortinet, Crowd, Checkpoint,
Fortinet's the cheapest. Fortinet is cheapest, but also it's not growing anywhere near the rate the others are.
So I've been observing the 30-day momentum constantly because they are in a correction of these 6 names right now. Palo Alto looks the best in terms of having relative outperformance. They're speaking towards moving into defensive technology. Well, tonight, you have a company that's reporting Salesforce, which none of us are really talking about. We used to talk about all the time. Is that an example of maybe something that's defensive software? And maybe we should be somewhat excited about what they're going to report this evening.
You got to buy a stock that's on the decline. I mean, I look at Salesforce in the same breath as I look at Adobe, and I know I've defended it, but I will tell you, and this applies to Salesforce as well, Adobe's going to report, I believe, next week, and if it doesn't respond, I don't care what the report is. If the stock doesn't move up, I think that's the final nail in the coffin as far as these sorts of truly defensive software names trading at mid-teens multiples, just giving up on them. I think Steve makes a very good point about the expensiveness of the security names, but the simple fact of the matter is they're expensive because they've been going up. And
Salesforce is down 24% this year, to your point of being a laggard. By the way, Mark Benioff, the CEO, is going to be on with Jim tonight on Mad Money following the earnings report. So you hear directly from him what he thinks the problem is for why his stock looks like it does, which has been, for the last handful of months, a nothing burger after having a pretty good slide to start the year.
I'll also say this. I like the discussion from UBS because what's only getting a little bit of mention is the fact that semiconductors or the hyperscalers are all spending a ton on CapEx. I mean, real assets that they're spending on. These are real assets that will require maintenance cap expenditures to keep up. It will have depreciation and amortization that hits earnings going forward. Traditionally, that has knocked multiples down. So when we're talking about a Broadcom at a mid-40s multiple, Steve, I think you make a good point there.
You know, the other part of that UBS note that we thought was interesting today was a blurb that said the following, quote, "We think the investment case for China tech, driven by AI model optimization and chip localization, remains intact. We don't see these latest measures as a signal U.S.-China tensions are again set to escalate." These are stocks we just frankly haven't talked about much. And over 1 month, Alibaba, now there was the announcement of the developing their own chip to make up for the lack of NVIDIA chips in China. That stock's up 16.5%, even more than that because this is updated right to the moment, up more than 17% over 1 month. There's Tencent and Baidu and the K-Web. You take that, right? Over 1 month. Weiss used to own some of these names.
Yeah,
maybe now's the moment, right? The notion that China is not going to be a significant player on the global AI stage is just flat wrong. And not to mention the fact that U.S. investors who are looking for ways to play AI beyond the mega caps and others are putting capital there quite obviously if the stocks are reacting the way they are.
Yeah, look, BABA is the cheapest. It's the best situated. I do, despite my aversion to stocks domiciled in China, companies domiciled in China. I look at it, and I've gotten very close to pulling the trigger. I may, because it's just so cheap, and that the company's got religion. It's no longer just the Jack Ma days. They're looking to maximize shareholder value as well, and they could be a leader in AI for sure, because they've got the balance sheet to do it, and that's what it takes, balance sheet.
So I jumped on the David Tepper train in January. I bought BABA. I rode it higher into April, and I will tell you that I am disappointed that I've gotten out of it now and wish I held it, because I do think there is fundamentally the case that can be made for this company to see its valuation, to get the multiple expansion that you're talking about, and for it to be able to deliver for shareholders well beyond where it was the 52-week high at 148. So I think you're talking about potentially 150. And of course, you could always text David Tepper and ask him if he's still in.
Well, actually, I did talk about it.
All right.
And he's still there.
Okay. Oh, he's still there? That's your breaking news?
Yeah. But I wouldn't break anything that wasn't public.
Oh, really? It's public that he's still there?
Well, look at his filings.
Don't try and cover you. Don't look at his filings. You know what now? Weiss, you already went there.
Look at his filings.
You can deal with the phone call later. News alert from Eamon Javers. Eamon, what do we know?
Hey, Scott, we know that the President of the United States was appearing in the Oval Office a short time ago discussing tariffs and the potential case at the Supreme Court that he's facing now. The President said that if the court doesn't go his way on tariffs and the legitimacy of his legal authority there, he may have to roll back a bunch of the trade agreements that he put together with countries around the world during the course of this year. Here's what the President said in the Oval just a short time ago.
If we didn't have the power, prestige, and dignity of tariffs, and I used them wisely, and people respect America again, and we've become a rich country again. The money coming in is incredible. And again, they use them on us. If we didn't have them, they would use them on us, and we would have no way to fight them. We would be a third world nation. So I think it's one of the most important cases I've ever seen go before the Supreme Court of the U.S.
Now, the president was asked by one reporter in the room, what's your plan B if this tariff ruling doesn't go your way? He didn't answer that question, just laid out his view of the history of tariffs in this country going back to 1850. He mentioned the 1870s, 1913. In the president's view, Scott, a world where tariff revenue makes up the majority of American tax revenue is preferable to a world where we use the income tax to finance the federal government. He's set that out as his vision. Of course, the math on that is tricky, to say the least, but the president wants to replace as much of the income tax as he can with tariff revenue, Scott.
Well, I mean, it's a critical part of his agenda, quite obviously. I mean, the Treasury Secretary himself suggested, Eamon, over the last few days, at least, that there is a plan B. I mean, there has to be, but it's not going to be nearly as powerful as just unilaterally deciding that you're putting on tariffs through an emergency executive order.
Right. And the question is, to what extent would the president, by any Supreme Court ruling, be forced to rely on other legal authorities, A, which are more convoluted and trickier to impose, or B, to go to Congress, given that Congress controls the power of taxation in this country, and get Congress to pass these tariffs? That would be a contentious fight every single time. What the president likes about his vision of tariffs is that it's been a relatively unilateral use of power, right? He can do this, or so he's argued, by himself with executive authority, and he doesn't have to go to Congress, doesn't have to wrangle the votes. You see how difficult that is, even on the continuing resolution that they're fighting for now to try to keep the government open. That can be a tricky fight every time. That really waters down his power to do this and to negotiate the way he wants to.
Yeah, and of course yesterday asking the Supreme Court to expedite this proceeding. So maybe we'll get an answer sooner rather than later. Eamon, thanks very much on the north lawn of the White House as usual. Eamon Javers for us. Up next, after a quick break, calls of the day. An upgrade for one of Joe's energy plays. It's hitting a new high today. And a price target bump for one of Jim's big bank winners. Halftime's back right after this.
Today.
Welcome back. Citigroup shares are down by about 1% today, despite the fact that they were reiterated the dominant number one pick by Mike Mayo. Reiterate overweight, 115 is the price target. The price target also raised at Truist to 105. Farmer Jim, this is your name.
I'm totally in agreement with Mike Mayo, who I've been in sync with for a couple of years on this. The stock now trades just a hair under tangible book value. I'm going to say it again, a hair under tangible book value. Everybody else is at a premium to tangible book value. It may be really big in JP Morgan's case, around 2.4 times tangible book. It may be smaller in the case of Bank of America, 1.4. But I submit to you, there is really no reason that there should be any discount to tangible book value at Citigroup. They have have been right-sizing the ship for the last 4 years. It's showing up in the results, reducing costs, increasing return on tangible common equity, and that's set to increase into 2026. Plus, there's a catalyst coming up in the soon-to-be spun-out Banamex IPO. There is a lot to like here. It's also at a discount to forward multiples of earnings. It's got a great dividend yield. I mean, I could go on, but there's more to come.
Let's even look at a 3-year. I'm trying to remember how long it's been since you started recommending the stock on this show as a true believer in what Jane Fraser was attempting to do. I'm glad I asked for that because it feels like it's been in around that time frame. Maybe you've owned it longer, but the stock is a near double over the last 3 years.
She's been in office a little under 4 years, and I've never seen a CEO not get a honeymoon the way Ms. Fraser did not get a honeymoon when she was announced as the CEO. It may have been because of the revolving door, Scott, you know this, the many CEOs who had gone through Citigroup's executive suite without affecting change. At first, the market did not believe it, but she's done the right thing. She's hived off those sections of the bank that were not earning their cost of capital. She's lent into those areas that are and that are profitable going forward, like investment banking, like wealth management. And again, this spin out of Banamex coming in the next, I think, 6 months or so should be a catalyst to then move the stock to a higher premium of tangible book value.
What's interesting is if you look at the 12-month change from a percentage standpoint among the big banks, she's the winner. As a CEO leading a bank and having the stock perform. Now, in fairness to everybody else, 49% for Goldman Sachs, no slouch. Right. And 49% Morgan Stanley, no slouch. But I feel like Jane Fraser doesn't get talked about as much as some of the others. And she's got a stock that's up 52.3% over the last 12 months. She has, year to date, by far, the best performing big bank stock in this market.
With more to go. Go ahead, Steve.
Yeah. What I'd say is that people vote with their feet. And what has been the stamp of approval on this is if you take a look at who she's been hiring, who's been willing to join Citi. It used to be the place where bankers went to die. Now bankers that are in the prime of their career at other firms, great firms like a Goldman, for example, are moving over there. So they know what's going on. They can go under the hood. So that's the justification for the stock doing as it has. Now, I still think it's cheap. This is another one I've looked at buying, just haven't had room in the portfolio. I already own 2 banks, but Jim's had a phenomenal call on it, and it's one I've missed, but it will keep going.
All right. What are we doing now? We're getting the news now. There we go. Silvana, hi.
Hey, Scott. Good afternoon to you. All right. Ukraine says the offer Russian leader Vladimir Putin made earlier today to meet President Volodymyr Zelensky in Moscow is unacceptable. In a post on X, Ukraine's foreign minister said Putin was making, quote, knowingly unacceptable proposals, adding at least 7 countries, including 3 Gulf states, the Vatican, and Switzerland, were ready to host the meeting. Iran grew its stockpile of enriched uranium before Israel launched its military strike in June. Multiple outlets reporting a confidential report from the UN's nuclear watchdog today found the country had more than 70 pounds of uranium enriched, up to 60% since the agency's last report in May. That is a step away from weapons grade levels. And while the leaders of Russia, China, and North Korea came together for a military parade in Beijing today for the first time in 60 years, the visit also marked the international debut of Kim's daughter, who was seen stepping off a train with her father, Kim Jong-un, yesterday. Experts say her appearance is a strong indicator that she may be Kim's successor. Scott, I'll send it back to you.
Okay, Silvana, thank you. Silvana Hanel. Up next, playing the next leg of the AI rally, our Leslie Picker standing by with your ETF edge today. Halftime's back right after this.
CNBC.
Leslie Picker is today's ETF Edge. Hey, Les.
Hey, Scott. Thanks so much. As you've been discussing September, starting with volatility, we're looking at ways to spread risk through ETFs. I'm Leslie Picker, in for Dominic Chu. Joining me now is Bryant Van Cronkite, Senior Portfolio Manager at Allspring Global Investments. Brian, thank you for being here. Let's just go ahead and set the macro stage. You are not convinced the Fed is a lock to cut rates this month.
Yeah, that's correct. The Fed has 90% probabilities that they're going to cut this month, and they probably do. That is the base case. But there is reason to be concerned that inflation still is above their desired target. Employment is clearly weakening, and a forward-looking Fed probably would cut rates here. But a backward-looking Fed, a data-dependent Fed, probably still could lean on the higher inflation rates and say, look, we don't have the deflation of the AI trend yet to support our price stability, and so we can't go too far. So it's not a lock, but I do think the base case is they cut and then pause from here.
So do you think they should be cutting then, given some of those potentially lagging AI deflationary pressures? Or do you think that they should be on hold, given all the uncertainty that's out there?
I mean, the reality as an investor is what I think they should do is less important than what they're probably going to do. And right now, I think they're going to probably cut. And as a result, as an investor, I need to think about what that does for the markets overall. It probably reaccelerates some of the investments in areas like housing. It probably creates additional return on invested capital through CapEx. And so it's a very offensive signal. And what I think they should do is less relevant to what they actually are going to do, which is probably cut rates.
Yeah, don't fight the Fed, as they say. So building on that idea of AI deflationary pressures, which sectors do you believe will be the biggest beneficiaries of this wider AI build out now ramping up?
Well, in the large cap space, there's been some very clear early winners, a very narrow set of companies, which we all know, and they probably continue to do okay. But investors probably should begin to look to diversify into other categories of additional or second effect AI winners. And I see a lot of that happening in the industrials and materials space. If we're going to build out this AI infrastructure and more companies are going to utilize it, we're going to be able to layer in the nearshoring and onshoring effects of the recent policy movement. And that's going to create a CapEx cycle that benefits the industrials and materials sector specifically. So we want to begin to move capital from tech into industrials, into materials, and let that now be the next leg of our AI winner trade.
Yeah, about the full supply chain there. Thank you so much, Bryant. We're going to continue the conversation over at etfedge.cnbc.com. Bryant will be joined by Todd Sohn, technical strategist at Strategas Securities. I'll send it back over to you, Scott.
All right, Leslie, thank you. Leslie Picker, straight ahead. Roughing the passer, the NFL throwing a flag on the service attracts its viewing audience. We already know it's big, but maybe it's even bigger. We'll break down the money on the line next.
powerful.
Welcome back. The NFL season kicks off tomorrow night on NBC with the Super Bowl champion Philadelphia Eagles taking on the Dallas Cowboys. And while a huge television audience is expected to tune in, there is a brewing battle between the league and the company that tracks its ratings. Our Julia Borston is here with more. Julia?
Hey, Scott. Well, the NFL's chief data and analytics officer, Paul Bailu, criticizing Nielsen, telling the Wall Street Journal there are millions of viewers that we believe they are systematically undercounting, also saying that the NFL is experimenting with measurement alternatives. Now, undercounting would have a meaningful impact on the NFL's ad revenue and also the value of its rights spread across streamers and broadcasters. The NFL does have a window to renegotiate its deals after the 2029 season, and it could open its negotiations with CBS sooner. Nielsen responding that it is working closely with the league to innovate around how it collects data and that it's, quote, confident that this will be the most accurately rated football season in history. Now, Nielsen recently launched a new measurement tool that draws data from 45 million homes, cable boxes, and smart TVs. Nielsen telling me that they are in active talks with broadcasters about getting more first-party data in addition to the new data that they are collecting. Scott?
Where does, if you know the answer, and maybe this is a dumb question, and if it is, I apologize. NFL Sunday Ticket, I mean, how does that factor into this conversation? Do they track the ratings for that if it's streamed? How do we know that?
So that's a different situation because that's a separate subscription, a separate package of games, which YouTube has the rights to sell. And so that is a different equation here. I think what's most in focus right now are the streaming of the new games on Netflix. They have the Christmas Day games. And then, of course, you have YouTube, which has, not YouTube, Amazon has the Thursday night games. YouTube has the Sunday ticket games. And YouTube actually has an opening week game, which we're going to be seeing this week, which is going to be streaming around the world. And then, of course, you have the broadcasters. But people are now watching broadcast TV, if you will, on so many different platforms. They might be streaming it on YouTube with live TV or Hulu with live TV, as opposed to watching it via a typical broadcast signal. So I think there's so many different ways people are consuming content, and the NFL wants to make sure that its rights are accurately valued. And the way to know that is to have really specific data about how much people are really tuning into their games on all these platforms.
It's always about the money. Julia, thank you very much. That's Julia Borston. Interesting story. I'm glad you brought it to us. By the way, do not miss the reveal of CNBC's official 2025 NFL team valuations. It starts tomorrow on Squawk Box, and be sure to catch Michael Ozanian's interview with Cowboys owner and general manager Jerry Jones. That's coming up on Closing Bell Overtime. And how timely is that, given the news of the last couple of weeks with the departure of best defensive player in the league, Micah Parsons?
Where did he depart to?
Your Packers. Yes.
Just want to make sure that's in there.
All right. I'm glad you added that, too. Up next, Santoli with his midday word.
All now.
Mike Santoli, our senior markets commentator, is with us. Your thoughts on the market today, which is obviously an alphabet-dominated narrative.
Yes, for sure. Alphabet and Apple holding up the S&P and the NASDAQ. Light pressure on the rest of the market on balance. In particular, semis, they've actually been kind of sloppy for another day, even though Broadcom was up. I also think you have to note the pronounced reaction in the bond market to that JOLTS data, even though it wasn't that far from forecast. Just that additional softening up of the labor market, supply-demand setup did have yields backing off, kind of cooling off from where they were yesterday. And maybe it means the market is now in the process of just tightening up ahead of the official jobs report on Friday. We want to stay in this line of pricing in September cuts, but not having to worry that there's another growth scare underway. So I think we're walking that line for now and see if we can continue.
I mean, we're walking towards rate cuts if Waller has anything to do with it, as he's already expressed, and he did again with Leisman, and now that just really ups the ante, I think, for this Friday's jobs report, Mike, don't you think?
It does, and it really is hard to envision exactly how out of bounds to the upside a jobs print would have to be to pull the market off of the September cut, expectation, whether that means it does reduce the cadence after September, or who knows. Look, things can change in a short period of time. We've seen that repeatedly when it comes to Fed expectations. But right now, it feels as if the bar is pretty high for really steering away from of a September quarter point cut, given what we've seen with inflation, the way the market's priced things at this point.
All right. I'll see you on closing bell, Michael. Thank you. Mike Santoli. Finals. We'll do them next.
We're not switching from
3 o'clock, closing bell. Dan Ives will join us. What this really means for Alphabet and Alphabet investors moving forward, Apple too. Lauren Goodwin, Courtney Garcia, Torsten Sloat from Apollo, Abby Yoder. And I will see you then on Closing Bell. Farmer Jim. So much love was flying around this set today for Farmer Jim.
Yeah.
I'll get used to it.
Long overdue.
I'm not going to hang on to it, but AstraZeneca is my
Save it.
trade.
Savor it.
Yep.
Because it could be fleeting.
I'll see you on Friday, Scott. We'll see if it lasts. AstraZeneca.
What do you
Cleveland
got?
Cliffs.
What do you got, Ted?
Only
Knight?
kidding, not Cleveland Cliffs. IBIT. The stock's
Did you
bounced
get that
off.
jacket from the Smithsonian?
This is style. Again, style.
They're going to change that exhibits over there.
IBIT.
You got it out.
Bitcoin's bounced off the lows. I think the upward trend's resuming.
Liz Thomas.
High div, low vol. The yield on this one is 4.6%, better than Treasuries.
Corning.
All right. Closing bell. I'll see you then.
Welcome to The Exchange. I'm Dominic Chu in for Kelly Evans today. Stocks are mixed right now with the Dow, the only index in the red. The NASDAQ is leading the gains, by the way, as you can see there. Alphabet is the big reason why. It's up nearly 9%, best performing stock in the S&P as Google avoids a breakup. Apple also higher with analysts calling it another winner in this ruling, but is it really? We're going to dig into that story. Yields are also moving lower. The 30-year briefly went back above the 5% mark earlier, but now back down to 4.89% following weaker July labor data. Job openings dropping to levels rarely seen since the pandemic. The latest data point showing the labor market is softening. And with that, rate cut probabilities for this month now stand at close to 95%. But we begin with Alphabet's big antitrust win and the ripple effects across the entire tech industry. The company will not be forced to sell its Chrome browser, as previously suggested by the Department of Justice, but warned it will be barred from the contracts that condition exclusive payments or licensing. Now, that means Google can no longer be Apple's exclusive search partner, but can negotiate annually to be the default, and that Apple can continue to collect traffic acquisition payments or TAC payments from Google's and others. Now, that move is sending Apple shares higher by more than 3% as well today. BofA Securities, however, says that data sharing with other search engines and generative AI providers could pose longer-term headwinds for Apple overall. That did not, though, stop the firm from raising its price target by $10 a share to $260 a share, implying a nearly 13% upside from here. For more on that call, let's bring in Wamsi Mohan, senior equity analyst over at BofA Securities, along with our very own Steve Kovac. Steve, I'm going to start with you first for the state of play.
Sure.
These are arguably two of the most important stocks in the entire market. Yeah. They have a huge amount of influence.
Next to a little company called NVIDIA,
next to NVIDIA, which kind of dwarfs everybody these days. But when it comes to Apple and Alphabet specifically, this dynamic now is shaping the market narrative for sure today. What exactly does that competitive layout look like given this ruling?
Yeah, and it couldn't have turned out better for Apple unless they, the exclusivity thing, maybe if they allowed that to continue. But look, this gives Apple a chance to continue to collect that $20 billion a year or more. It's based on how often people search from Google. That's about a fifth of total services revenue for the year. It's a $100 billion business. 20% of that is coming straight from Google. So there's that. Then the negotiation part, I find this really interesting, and we'll talk to Wamsi about this in just a second here, is their ability to go back every year to Google as AI search becomes a bigger and bigger thing and a bigger market share of how people search for things on the internet. They can start using that leverage now and saying every year, go back to Google and say, we got something good over here from OpenAI. We got something good over here from Anthropic. And by the way, Dom, they're already doing that. They are talking to all three players I just named about how to power Siri next year with this big AI update that they failed to deliver this year. They failed to build their own LLM. They're going to partner with one of these big guys next year to make that happen. So this really gives Apple more leverage, saying, you want access to our billion iPhone users? Great. Show us what you can got. And by the way, there's some real competition now, Google.
Of course. And so, Wamsi, let's kick off that conversation with you on that, because this has been in play for probably about 2 or 3 years now. This idea that search is going to be gradually, maybe if even rapidly replaced by using ChatGPT or other these AI-type, search-type products. What exactly does this now mean, given the fact that there is now an annual renegotiation, a rejiggering of the state of play for all of these different players? The economics have to change. And what exactly does that mean for a company's future valuation?
Yeah, no, thanks for having me, Dom. Look, I think that the big thing here that we got to keep sight of is that this was a pretty big risk from an Apple standpoint. Steve just mentioned, $20 billion out of a $100 billion business. So on total company, it could have been 10 or 12% of earnings that could have gotten washed away if the ruling was adverse. And frankly, the ruling is not, which means that I think the buy side here was already expecting about 50% probability of it going the wrong way. And since it didn't, we actually think that an earnings cut of 10% was avoided, and half of that was baked in. So we think the stock should be up about 5%, just based off of the fact that there was so much negative headwind that was baked into Apple's valuation. So that's part of the reason why we raised our target price to $260. As we look into the future, the way we think about it is that the share of Google searches is clearly going down in the broader scheme of things, but the rate and pace of that will be something that will be managed. And then you also have Gemini, which could be substituted, whether it is AI search within Google, which could be augmented and potentially not cause a headwind, or it could be using Gemini models within Apple's own Apple Intelligence based solution. And obviously, they're talking to a bunch of companies, all the ones that Steve mentioned here, and that means that over time, Apple has this hedge versus just being exposed to Google's revenue itself.
Now, Wamsi, this is also an Apple story because Apple is in essence the platform for all of this, right? You can open yourself up to many of these, I'm going to call them apps. I know that's an oversimplification of it, but these AI products, these new kind of bolt-on tools are going to be on these platforms. What exactly does it mean for Apple's relationship and its future valuation, given the fact that all of these players may be part of the ecosystem or not at all, given their negotiations with Apple?
Yeah, it's a great question, Dom, and it's hard to prognosticate exactly who will be a winner over here, but the way we think about it is Apple is clearly going to be a winner. And why is that? The distribution of these is extremely, extremely important. I mean, it's been proven in search. I think it'll also prove itself in the Gen AI context. The payments might not be coming in the same way, though. The way we expect this to evolve is that Apple will strike a partnership to have these models ultimately run on Apple servers within Apple's own data centers so that they are the keepers of users' information. Remember, privacy is super centric to Apple. They're going to make sure that the data stays on their servers, which means that they might take these models, train it on Apple silicon, run it on Apple servers at the end of the day, and extract value for customers that way, but keep this whole thing private. So it could be a licensing agreement that they do with some of these model providers, and there could be multiple of them. And depending on the use case, that gives them some leverage to negotiate across all of them, right? And so on the one hand, you've got sort of this model dynamic. The broader dynamic is obviously, these can be apps, put simplistically, running on your iPhone at the moment, and Apple will be monetizing those through its services business as usual by taking some kind of cut or revenue share in the more traditional sense of the App Store. So there are multiple ways of monetization. I think it just depends on the rate and pace of what Apple's internal development does relative to what these external providers are able to provide and the negotiating terms that they give to Apple.
All right, Steve. We've got a big event coming up next week.
Next week, I'll be out there.
That showcases Apple and lays out a possible game plan for what things look like in the future for not just AI, but for everything else. So does this dynamic affect what you're going to expect at the Apple event coming up later on next week?
I don't think this is going to impact the event so much, and I don't even expect to really hear much about artificial intelligence. It's all going to be about the phones, which is what Apple is the best at. I do want to point out something. Notice how Wamsi did not say they need to go out there and acquire a big company. They need to go out there, like we've been talking about all summer long, go out there and buy Perplexity or Anthropic like that. That conversation is over now, effectively, because of this decision. They don't need that because they can continue their search relationship with Google. To use the other one. Or if one day someone does create something, if Perplexity does end up being better than Google, they can, in a cheaper fashion, partner with them as opposed to acquire them. So again, what we're going to see next week new phones. They're going to be a little bit better, a little bit faster. The camera's going to be a little bit better than a year ago. The big one is this thin phone. They're calling it the iPhone Air. That's what the internet has dubbed it. And that is going to be the most exciting model to see. It will be a real good test case to see if changing the design for the first time in 5 years can actually grow sales in a way AI did not last year.
We're looking for catalysts, of course, for that buying going into this kind of holiday shopping season as well. All right, Wamsi Mohan, BofA Securities, thank you very much for joining us. Steve Kovac, thank you very much as well for the conversation. We're going to keep it right here with technology, staying with Alphabet and the antitrust victory. The ruling has major implications for the generative AI space as well. Mackenzie Sagalos digs into what this means for Google and the AI startup landscape. Mac.
Hey, so going into the ruling, Dom, there was fear it would send shockwaves through Silicon Valley. And instead, it is being read as good news, not just for Google, but for the handful of well-capitalized players dominating the AI market. An ex-Google exec called the remedies a slap on the wrist. And in practice, it does translate to no real changes in how Alphabet already operates, which ultimately bodes well as it battles for share in the AI race. Now, most importantly, Google keeps control of its reach, Chrome and Android, along with its ability to negotiate default status on Apple's 2 billion devices, as you just discussed. Now, the judge made clear that what justified allowing Google to keep those advantages was the rise of its Gen AI rivals. He devoted 30 pages of his ruling to citing OpenAI, Anthropic, and Perplexity as proof that the market is competitive. And even the harshest requirement here, sharing search data, may be delayed by years if this goes through the appeals process. Executives I've spoken with also say the ruling reopens the M&A pipeline, so expect more sub-$1 billion acquisitions and acqui-hires like Google's Windsurf deal. Washington, they argue, doesn't have the teeth to change Google's position. Meanwhile, liquidity is flowing to the private AI giants. OpenAI running a secondary sale this week at a $500 billion valuation to keep its talent happy and give VCs the increased exposure that they are looking for. But smaller startups without that cash or investor appetite face a much tougher fight for talent ahead, Dom.
All right, so Mac, you mentioned all of those three big AI players right now. We're talking OpenAI, Perplexity, Anthropic. How exactly did these developments for Alphabet / Google and Apple change the landscape overall for those AI the players, the privately held ones? We just heard Steve and Wamsi talk about this idea that maybe Apple doesn't need to go out and make a big acquisition in AI because now the source is now open for competition for all of these different platforms.
Yeah, so you really have these two camps of AI darlings out here in Silicon Valley. On the one side, you've got your model builders, an OpenAI or an Anthropic. And OpenAI could, in part be credited with the more lenient set of remedies that we saw here because it has put Google on its back foot since November of 2022 when it launched ChatGPT. Google rushed out a really botched chatbot as a response to that. Now, I'm also talking to insiders within OpenAI, and they say that they are not focused on this antitrust ruling. They have their head down. They're continuing to raise tens of billions of dollars, and they are building the tech. They're going out to enterprise to try to capture more of that market at the same time that they are advancing their models. And then that other camp of AI players is where Perplexity falls. That is a wrapper. It builds on top of other LLMs, and it has a very flashy valuation right now, but what a lot of people are talking about in the background is whether that holds up now that we've seen this very lenient outcome for Google.
All right. Mackenzie Sagalos there with the state of play on not just Alphabet, but OpenAI and all the others as well. Thank you very much for that. Coming up on this show, President Trump says he'll ask the Supreme Court for an expedited ruling on his tariffs appeal. But if the decision doesn't go his way, the White House still has some other ways to enact the president's trade agenda. We'll tell you how that happens possibly next. Plus, lawmakers back on Capitol Hill after a 6-week break, but they only have about a dozen days left to avert a potential government shutdown. We're going to look at what it'll take to strike a bipartisan deal next. The Exchange is back after this.
This is The Exchange on CNBC.